Big economic data came in today. Wanted to talk about SPY stock today. What's going on with SPY stock? The economic data, of course, pushed the market up a little bit, but then it kind of softened off. So, what's going on? What's the breakdown of the latest economic indicators? What's going to happen with Treasury yields, and how will that affect SPY stock and the stock market broadly speaking? I've got a few charts I want to kind of show you. Take a look at what I'm looking at. Bottom line is simply this. Yeah, we'll get to 2% eventually, but it's going to be a long, slow grind at the current pace. The current pace, it's too high. I've got some charts I want to show you. Let's jump in. PCE index came in, the deflator. What is it? So first we get personal incomes and then personal expenditures. The PCE is the personal consumption expenditures deflator. And basically what it looks like is price, it deflates the price to kind of give it a broader look as to where it was comparatively a period of time before. The core PCE rate came in at 0.412%, 0.4% month over month. The annual rate, of course, we're right at 3%. What I did is I took a look at the current rate, the current PCE core number, and then I took over the next 4 months 0.3, 0.3, 0.3, 0.3 month over month increase, and I did that cumulatively. Then I did the next 4 months 0.2, 0.2, 0.2, 0.2, then of course 0.1, 0.1, 0.1, 0.1 month over month for 12 months. If we see those numbers, the next 4 months, 0.3 month over month, the next 4 months after that, 0.2 month over month, then the next 4 months after that, 0.1, we will be at 1.98% year over year gain. That would be the target rate for the Federal Reserve. If we do not see in the next 4 quarters 0.3, 0.3, 0.3, 0.3, we're not going to hit a 2% target rate in a timely enough manner given the current interest rate outlook. With where interest rates are, how the economy is expanding, we've got what, a 3.7% unemployment rate. We get unemployment numbers coming out next Friday. This will reiterate that employment gains are there, still robust. And because of that, interest rates are going to remain higher for longer. Because of that, stocks may have a tough time moving higher. But at the same time, we also have a lot of things that are positive going on with the economy. Not only do we have full employment, but there's some other variables that are sort of outlying. I've got a chart on oil. Oil is important. OPEC has been slashing production as much as they can, yet oil prices have gone nowhere worldwide. China, the X factor right there. Their economy is slowing down. So aggregate demand for basic commodity prices isn't quite there. So this is one of the reasons why we're seeing inflation numbers kind of moving lower. But there's another variable that you also have to keep in mind. So although China is an important thing, the other thing is, of course, housing. Housing came in within the PCE deflator. Housing came in at about 6.15% for year over year gain. That's a little higher than the Federal Reserve would want, but the Federal Reserve doesn't target housing. They'll look at the core rate and say this is where inflation is, and that's great. Housing inflation numbers are declining, but they're still 6% year over year. If we start to see housing prices moving higher, that could push inflation higher. Keep in mind, 70% of the gain we saw in inflation previously was housing. I've got charts on that coming up. In the meantime, here's a 3-minute bar chart on SPY stock. SPY stock, of course, not really making too much of a move. Shot up a little bit. We are in record territory for a couple of the indexes. Sounds great. AI stocks, of course, are still continually pulling in more and more investors. There's a lot of growth there for AI stocks. I just put a video up on AI stocks yesterday. I've got a ton more coming out, so make sure you follow along. But when you look at SPY stock here, kind of lost its steam. The U.S. 10-year Treasury. This is the what 2 hour bar chart. Not really a whole much big of a move. It did fall downward on the initial news for PCE deflator, but then yield itself kind of moved right back up. We seem to be stuck right about here. And this is something I've been kind of saying, that I don't see moves higher in yield so much or lower, that we're going to be stuck kind of hanging out at these rates. That for me is the time to start making money when I sell options against, say, TLT stock or something like that. Here's a look at personal incomes. This is where I start my analysis. You got the three major areas for the economy: government, business, personal. 70%, over 70% of our economy is consumer driven. So if you follow year over year growth rates in personal income, you're going to see year over year growth rates for personal expenditures. Here, let me show you that chart real quick. Moving as well. These two run hand in hand. They tend to, they're real close in correlation, but not a perfect one. As you can see, expenditures is pushing higher. This will push businesses forward. Expenditures turn into revenue for companies. Revenues, of course, turn into profits. Profits, of course, turn into stock prices for SPY stock, other companies like that. As expenditures move higher, revenues for companies are going to do exactly the same. It's one of the benefits to having an unemployment rate at record levels, 3.7%. This is well beyond what economists used to consider full employment. So as personal expenditures move forward, and here's a good look at this. This is the same chart, but I put the median there. As you can see, it's right at the median for going back to 1990, what I consider mostly the modern economy. We could go higher, we could go lower, but with a full employment, you're going to see expenditures continue. Since we did have a dip, you're probably likely to see previously the dip going all the way through 2022. We're likely to see moves above the median number for personal expenditures. That turns into revenues for business. The important thing, kind of one of the takeaways here, government expenditures tend to be pretty flatline, so it's really not going to accelerate or decelerate economic expansion or contraction too much within any particular economy because of its flatline nature. Businesses largely respond to consumers. There are some aspects of business that would initiate growth within the economy, but when you're looking at 70% of the entire economy being driven by personal expenditures and consumers in general, that's really where you want to focus your attention. That being said, of course, government, Biden, the administration pushed through its Anti-Inflation Act, and this is propelling the economy forward at a time when it needed it because the Federal Reserve just rocketed interest rates up due to inflation as much as they did. So we should see personal expenditures crossing the median number here into more of an expansionary, which would be beyond, say, normal on aggregate. PCE inflation deflator, this is headline, continues to move lower. Not really something I'm going to be focused on too much, simply because this includes food and energy, which are very volatile. But here's your core PCE inflation deflator, falling below, I think it was like 2.89% was the actual number. But again, 0.4% month over month gain, despite dropping below the 3%. A lot of some of the analysts I've been reading on sitting there saying, yeah, we're going to get there. But I saw some blurbs coming out of, say, JP Morgan, where they're saying, sure, we're going to hit the 2% level eventually, but it's going to be a long, slow drive getting there. But here's the housing inflation deflator that I really wanted to kind of look at. And we're still above the 6% rate right here as you're looking. Housing is one of those X factors that you really need to pay attention when you're considering what's going to happen next with, say, SPY stock. All right, the broader stock market. On the one hand, yeah, China slowing things down. Great. that keeps some aspects of inflation kind of moving lower. But if we see a big move higher in pricing for housing, which the supply and demand of housing is so skewed and will take literally decades to kind of fix, this could be something that keeps inflation higher for longer, which would keep bond yields higher for longer. So this is something I am kind of focusing on. Another aspect of China, of course, as they slow down, as they have been slowing down, core rates on certain things such as oil. Here's a look at oil. As you can see, we're pretty much just stuck right there. Keep in mind, OPEC has been slashing production. Price really hasn't gone anywhere. So if you have less supply, classical economics tells you that with less supply, price would go higher, except demand is shifting because China is slowing down. One final thing to look at, I wanted to take a look at gold. Again, gold not really making too much of a move. Dollar itself spiked a little bit as we keep bond yields higher. The dollar will, versus its counterparts, tend to be higher as well. So that's what's happening there. Gold, of course, I kind of would have expected gold to move lower because higher interest rate yields mean or tend to mean that we're going to see a lower price there, but that didn't happen. Make sure to hit that like and follow button if you want to see content where I break down economic indicators and how they would affect the stock market. SPY stock, one of the things that I follow and trade on a regular basis, the bond yields and things like that. Make sure to hit that like and follow button. Thanks so much for the comments. The channel is growing very rapidly. We'll see you in the next video.